One of the biggest complaints I hear from retirees is how much they pay in taxes. If you think tax planning ends on April 16th, think again. One of the best ways to reduce your tax obligation over your lifetime is to do planning now. I can tell you, I have so many friends, family, and clients who are just absolutely captured by the taxes that they owe once they get to retirement. This is because they took great advantage of tax-deferred opportunities while they were in their earning years. So they paid less tax while they were earning, expecting that they would be in a lower tax bracket after they retired. Unfortunately, for a lot of folks, it doesn't work out that way. If you've saved a lot working over the years, you might even end up in a higher tax bracket in retirement. One way to try to avoid this is take advantage of the Roth opportunities that exist while you're working. Sometimes this isn't so desirable. What it means is you pay the tax now to put money into a Roth, either a Roth 401k or a Roth IRA. That money is after tax. You pay the tax in the year that you earn it. But the growth is tax exempt forever. When you want to take it out in retirement, you don't have to pay taxes on it. And that is a huge relief. If you're thinking about contributing to a Roth IRA, you may already know that there's a limit on the earnings that you're allowed to have in order to contribute directly to a Roth IRA. There is, however, something called a Backdoor Roth. This is a process where you make a contribution to your traditional IRA, don't deduct it, and convert it into a Roth IRA. This is advanced tax planning, so you don't want to just do this. You need to check it out, discuss it with your tax preparer, and don't do it last minute on April 14th. Talk about it when you're planning for the year, during the course of the year. One thing that you can do in your earning years to try to ease that tax burden for later is really leverage your health savings account, HSA, opportunities. An HSA is an account that you can contribute to while you're working, and that money goes in pre-tax. If you don't need it or spend it in the years while you're working, you might be able to invest it. And if that is possible, then the growth that you get from investing is also tax exempt. When you finally get to retirement and you need withdrawals for things that are health expenses, you can take withdrawals from your HSA, and those may be tax exempt as well. It's possible, if you use an HSA properly, it can be triple tax exempt. Definitely something to discuss with your CPA when you're doing tax planning.